I know that it's night over there. A lot of us, are very much ready to go to bed already, and you're just making our time to be here. So I'll try as much as possible to manage the time effectively. And as I share my screen, what are you looking to, what are your expectations for this presentation today? I want to have it in the chat room. We're going to be talking briefly about personal finance and investing. What are your expectations? Why personal finance? Why do you think it's important, and what are you looking to achieve with this section? I just want to know. I just want to hear your thoughts. Just put it down in the chat room. I'm looking forward, to a nice time with everyone myself. I hope you can all see my screen.
Yes, we can.
Thank you. Okay, so yeah, so I'm almost not seeing. Okay, the chat room.
Yeah, so I can see a lot of comments in the chat. We have from Brenda. She says we need to know how to manage and multiply our money. Dollar is not
Wow.
smiling. Yeah, so Adenike is looking out
Yeah.
for what to choose. She wants to know what to look out for when choosing an investment opportunity.
Good.
Oluwayomi is wanting to be better equipped with, knowledge regarding investments. So
All
yeah.
right.
And Bumi
Good.
says, how can we invest and earn in dollars? Yes. I mean, how can we do
Correct.
this? No
Yeah.
story.
Thank you. Thank you so much. Yeah, so I'm more confident, now hearing your thoughts, and I think that at least we're going to be able to touch most of the areas you're looking at today. I dovetail that, back to what we're talking about, which is personal finance and investing. What is personal finance? What does it mean to you? You've talked about investing.
Hi, Dolapo. Sorry about that. Do you want to put your screen in presentation mode?
Presentation. I tried, but I'm not okay,
Yeah.
because I have another screen here and I'm trying to have access
Okay.
to that other screen. So that's why I'm not putting it in presentation mode. I hope you
Okay.
forgive me.
That's fine. Anyone can work with you, I know.
Yeah.
Yeah.
Thank you. Thank you so much. Yeah. So why personal finance? We'll start with that. Why personal finance? Talking about personal finance, it's financial management, basically financial management for individuals, for family units. You're looking to budget, you're looking to save, you're willing to spend monetary resources in a way that ensures that you're able to cover your financial risk as well as your future life events. So basic things, the financial risk, the risk that you may not be able to meet your expectations, of income in the future, and then your financial needs in the future, basically. So those are the two reasons why you're looking at, financial, personal finance. And why personal finance? I just look at why we're looking at personal finance. As I've said earlier, you're looking at the fact that you have, financial risk, and then you have needs to be met in the future. And because you have, unlimited needs and scarce resources, there is a need for you to efficiently allocate those resources to meet those needs, because you cannot possibly meet all of those needs. As economists told us, you have unlimited needs and then you have those scarce resources. In terms of monetary resources, it is scarce because there's a lot of things you want to buy, there are a lot of things you want to own, there are a lot of, stuff you want to do with money, but those resources are not, enough to do what you want to do. So there's a need to efficiently allocate to the most, important, have an order of priority. And that is why you need to understand personal finance. And then another reason is to meet your financial objective goals. Maybe you want to study abroad, you want to move abroad, you want to build houses, you want to own cars, you want to finance your children's education. Those are all financial objectives or goals you need to meet. And you need to understand personal finance in order to meet those goals. And then talking about financial security, financial independence is states where your money begins to earn for you. You're no longer, having to work before you earn. Your money is, working, doing the work for you. And that is the stage of financial security. So that is where a lot of people are looking at. They're tired of working, tired of the 9 to 5. And that's why they want to know about personal finance. Another thing is transgenerational wealth. When I see this, what comes to my mind is Coca-Cola, and what we hear about the Awolowo family, that for every Coca-Cola bottle that you drink, some, kobo actually goes, to the Awolowo family. So you can imagine this. He's died, I think he died since 1987, but you still find out that his family can still benefit from whatever investment he had actually put in place. And that is transgenerational wealth. So some people are looking to personal finance, not to meet their own needs right now, not to meet their own future needs, not while they are alive, but they're looking to transgenerational wealth that will succeed generations after them. And then you're looking at asset growth. Looking to own more houses. You have your own house right now, but you want to own more houses. You want, to have real estate. You want to build new companies. You want to invest in, different endeavors in order to have all of this begin to work for you, to begin to earn more money for you. That's asset growth. And the last but not the least, which is also very important, is debt management. Some people have made some decisions in the past, to actually increase their wealth, and they have gotten into debt, and there's a need for them to be able to manage these debts. And so personal finance is really very important. I'm sure that all this that I've mentioned, somehow one or two of them, or even more than that, applies to every one of us here. And it's very important that we just try to pick whichever one applies to us, because personal finance, just as it is called personal finance, is personal. We all have different situations, and you just need to understand. The mistake we make most of the time is that we follow, there's this head mentality when it comes to finance, when it comes to investing. We want to follow what our friend does, follow what somebody said, without looking at, is this person's situation the same situation I'm in? And that is, one thing we need to stop doing. Stop, following what people say, I'm investing in these. I think is a very good investment for you. No, it's not good for you until you're able to determine whether it is suitable to your own situation. And that is why it is personal finance. And so we dovetail over to aspects of personal finance. Now, I'm sure that what comes to our mind a lot of times when we talk about personal finance is how to save more, how to invest. But it's not just about savings and investments. There's also financial protection. There's tax savings, which is very important to those of us maybe in developed nations, not in Nigeria. And there's retirement planning, which is really key for every one of us here, because one day would all leave this earth, and it's very important for us. And one day would all stop working. You understand? As in, if you grow old, up to a point, you will not be able to work again, and then you would still need to eat, you will still need to wear clothes, you still need to go on those your vacations, you still need to get new cars and all of that, but you're not working, you're no longer earning. So that is why you need to, have a knowledge of what it means. You need to put in place your retirement planning and legacy planning as well. First of all, savings. You know what savings is all about. Savings is just putting money aside, from your regular needs, for money to meet your regular needs, to cover any, financial need in the future, basically. And you heard me, to cover. So you're not just saving for saving's sake. A lot of people just save, just someone said, I should just save 10% of my income. And so what are you saving for? There's no goal, there's no savings goal. And someone said, when purpose is not known, abuse is inevitable. So you need to understand your savings goal. You need to have a goal in place before you start saving. Are you saving in the short term? Are you saving in the long term? Are you saving in the medium term? How many years? How many months? How much are you going to save? What is the frequency of savings? All this needs to be understood, because that is the only way you'll be able to follow your savings plan when you have a goal. If you do not have a goal, you'll likely not be able to make anything out of savings. And then the next thing is investments. And so when you've saved, most of the time savings is usually short term, because you're just looking to meet any sudden, financial needs that may come up. But investment goes beyond savings. Investment is, important to be able to grow, that money that you have set aside, and in order to be able to achieve, whatever needs, whatever whatever things you look to aspiring in the future. So those investments, could come in different ways. Just like savings, you need to have an investment goal as well, because you're looking to need to meet in the future. Maybe you're looking to travel, you're looking to meeting your retirement goals, you're looking to fund your children's education, you're also willing to improve yourself, maybe go back to school. All of that, you investing towards that. All of that needs to be tied together in investments, and then understand the reason why you're investing and have those goals in place as well. Then financial protection. I spoke about this earlier. When you have, financial assets, the truth is that anything can happen. Risk, of you not being able to meet, that expected outcome, maybe anything happens, health risk, could come up, premature death risk, God forbid. We always say, God forbid, nobody wants to die, but we all want to go to heaven. So, all of that, anything can come up that will stop, that will reduce your financial assets or completely stop. So you need to put in financial protection in terms of health insurance. Some people are earning very well and they're working in very good places. At the point something happens, they are sick, and all of whatever income they have saved has to go towards taking care of this illness. If they had put in a very good health insurance, probably they would still be able to, weather the storm and then go back to work. So you need to put in those financial protection, health insurance, your life insurance, property insurance, very important. You cannot underestimate all of this as to, all this is insurance. You need to have some form of insurance to protect your financial assets. And then we talk about tax savings. Tax savings is, much more peculiar to those in developed countries, not very big in Nigeria, maybe big if you're into business, if you're an entrepreneur. You need to ensure that, tax is something that is well taken care of in order to reduce your taxable income. You're trying to, as much as possible, legally not evade tax, but avoid tax using, the legal means, like putting your funds in tax-free savings accounts, having tax-deferred accounts like the retirement savings accounts, where you can put in your funds that you do not need now until retirement. And then when you get to the retirement stage, you can draw on them when your income brackets are lower and your taxes, your tax rates are lower at that point. So those are all different ways. Your financial advisor can always let you know different ways you can actually reduce your tax burden. For those in Canada, those in the UK, those in the US, this is very important. If you're not looking at it now, it's important you start to look at it, because a lot of times people just burn their fingers because they're not really considering this aspect of personal finance. And then the last one will be retirement planning, which is very key. Retirement planning should not start when you are 50 years old. Retirement planning should start essentially from the first day you start to work, you start to earn. You should start to think of when you will no longer be able to work. So you need to put something in place. And what you're putting in place is not the statutory, what, the government, whatever the government is, that is not going to be enough. We all know if you're going to have to rely on the government pension to have that kind of baby girl lifestyle that we all want to have. We all want to have vacations in Seychelles, have vacation in Morocco, go on cruise and all of that. When you're retired, you cannot do that, with the pension from the government, for instance. So you need to have a very solid retirement plan, and that needs to start when you start it. So if you've not done it, there's nothing that is too late. You don't need to beat yourself too much. All you need to do is start to put a plan in place, and the plan has to be a solid plan. It's not just something you're thinking, oh, okay, maybe we can, maybe I can do this, or maybe some business when I've retired. It has to be something that is that you're sure of, that is guaranteed, maybe an annuity. An annuity, some people invest in annuities, like put money, in some investments that will now pay them like annual sums when they retire. So the investment would mature when they retire and then pay them those annual sums. There's so many, means you can go talking to your financial advisor, and they can, or insurance providers, and they can actually advise you on what, it takes for your retirement planning. So it's something you need to take very seriously. I know that in Nigeria, it's not something we take seriously. A lot of people see their children as their retirement plan, which is not the best. I'm sure that our generation is, not like that again. So it's something that we need to look at. Yes, so to understand all of this properly, I'll just quickly talk about the financial stages of life and risk. This is financial analysts, talk about financial stages of life. Financial stages of life that we have, we're just looking at your life in terms of what stage of life you are in, you understand, and how those stage of life explain the financial risk that is faced at those different phases, basically. So you have the early career stage. I've talked on some of these points earlier. The early career stage is, when you're just entering into the workforce, you're new, you just started earning, you are just starting a family, assuming personal responsibilities. Money is not really, you've not really acquired enough financial assets. But at this stage, what you have is what we call human capital. Your human capital is substantial. I will explain those terms now. We have human capital, and then we have the financial capital. For your human capital is just the discounted value, the discounted present value of all your future income until retirement. So for instance, you just entered into the workforce, you're 25 years old, and it's assumed that by 65 years old, you're going to retire. So between 25 and 65, you have 40 years. Your human capital today is the discounted value. So we're going to present value all your income for those 40 years up till today. That is your human capital. Your financial capital is whatever assets you have in your savings accounts, your investment accounts, what you have today. So you can imagine for someone 30, 25 that is just entering into the workforce, of course, does not have so much saved, because they've never worked, but they have substantial human capital. Your human capital is highest during your early career stage. And, there's some risk that are inherent in the stage. The first is your earnings risk. Earnings risk can occur as a result of loss of job, illness, or any disability that will stop you from earning, basically. So, and that can happen to anybody. People start jobs and they lose their jobs, but it's not something that we pray for, but it's a risk because it's something that can happen. You understand? Any possibility of something happening, deviating from your expected outcome is a risk, right? So if there's an earnings risk, you need to, think ahead and be able to mitigate this risk. We always advise that you have a savings buffer. A savings buffer is at least 6 months earnings at any point in time. If you're working, you must have at least 6 months salary. If you're earning 200,000, 400,000, 500 every month, multiply that by 6 at any point in time. If you've worked like 2-3 years, you should have 6 months, earnings saved somewhere. If anything happens, you can always fall back on it, right? And then another risk inherent during the stage is the premature death risk. God forbid, if anything happens, it means that you will not be able to, cater for the needs of the children. Whoever is your, your survivors will be at risk because they will not be able to get, whatever they were getting from you. So you need to put something in place. And what that is, your life insurance. Your life insurance has to be in place right from the early career stage. And then we go to the career development stage. During the career development stage, you find out that individuals have become established in the career. They're starting to expand, the job skills are starting to expand. They start to, you know, have more responsibilities down during the early career stage. Funding the college education of children, funding, you know, children that are going to school, you have to take care of the family, they are now married, you know, a lot of other needs come into place, but they are earning better than they were earning during the early career stage. And then typically at this stage, you find out that people begin to accumulate financial assets. So unlike in the early career stage, financial assets, you know, are beginning to increase, other than, you know, and human capital is beginning to reduce, right? Because you have less years to retire, basically. So during the career development stage, you have almost the same risk. You have the earnings risk, you also have the premature death risk. But in addition to this risk, you have property risk, because you most likely acquired a house, you most likely acquired a car, so you have property risk. And those risks have to be insured. If anything happens to that car, maybe a fire accident, an accident, you have to replace the car, that will deplete your financial capital. The same thing with your house. If there's a fire accident and it goes, you can imagine that effect on your financial capital. So you need to be able to protect this risk, protect the risk, have a property insurance, fire and peril insurance in place, protect the risk for cars, make sure you have a comprehensive insurance. You could also have liability risk. Liability risks are like third-party risk. If anything happens, you're driving and you mistakenly hit someone's vehicle, you're liable for, you know, whatever happens to that person in that accident. That's a third-party risk that has to be insured with a comprehensive insurance. So all this needs to be put in place during the career development stage. And then you go into the peak accumulation stage. For the peak accumulation stage, just like the name says, you are accumulating financial capital already. This is a stage where everybody is, you know, kind of, you know, scared of, you know, retirement. You know, you want to ensure that you're able to retire and have enough investments. And then at this stage, you discover that the need, you know, to fund education of children, you know, starts to decline, because generally the children are leaving school, but then you are anticipating retirement and putting together funds, you know, to ensure that you're able to retire very well. So the career risk can also be high during this stage, because as much as, you know, you're also doing all of this, your age in the workforce, you're close to retirement. It's not very easy for you to get another job if you lose your job. So that you need to think about it. So there's still the career risk, you know, the earnings risk is still there. And then most important risk at this stage is the investment risk, the risk of putting your investments in the wrong, you know, vehicle, put your investment, make wrong investment decision and lose your funds. There's also the health risk at this stage as well, if you've not put, you know, together a very good health insurance. Of course, for early career development, you should have had a health insurance from the beginning, so that, you know, you also need to also look into that health insurance at this stage as well, to ensure that it's able to cater for any, you know, lifetime needs that you may have in terms of illnesses and all of that. So the next one will be early retirement stage. During the early retirement stage, as the name implies, you just retired. And what happens at the early, what happens to your human capital, of course, is non-existent. You're not earning again. What you have right now is whatever you have accumulated in terms of financial capital. And there's a risk to that, because you're not, it's just like a closed box. Nothing is really coming in again. So, but you're having outflows, basically. So you're having outflows, but you're not really having inflows. So you need to be conscious of, you know, of course, you find out that at this point, retirees would definitely try to cut on spending. They want to cut on, you know, those luxury that they would have, you know, when they were working and all of that. So, but you need to be very careful about health risk, because usually you find out that illnesses will prevent people from enjoying life. So you need to put something tight. At this stage, something has to be in place that can take care of your health so that it does not deplete whatever interventions, whatever health issues you have would not deplete the financial capital that you have accumulated. The late retirement stage. This stage is, I would say for developed nations, this stage is more of a concern, not really a problem for us in Nigeria. And the reason is because of our expected life expectancy in Nigeria is much lower than, in developed nations of the world. But then it's still there. If you live long, there's a longevity risk. Longevity risk is a risk that you would outlive the financial resources that you have actually accumulated. So it's really yes, it's a concern for them here in Canada. They're so scared because everything is planned up to like the age of 95, 90. After that, if you're leaving on your terms. You understand? So they're always, scared when they start approaching, those 100 years, would I still be able to, care for my needs? Would I still be able to care for my basic needs, at that? And that the health issues also compound at that stage. And then eventually the government has to take over. So that is also a risk for some people, at that stage. All right. So yeah. So we go over to the next stage. And I always say that, sorry, it's blocking. I hope, okay, good. I always say something on personal finance. You need to, before you start, a financial plan, you need to understand your starting position. And this is very important. And that's why we're talking about your net worth. What is your net worth? I'm sure that we've heard it severally. What's your net worth? And it's very important that you know your net worth before you start thinking. Before I go into your net worth, let me quickly just share something. I remember when I just started working, it was about 1.5 years, into, working. Then there was a training at work that I had to attend, a training on, I think it was something about personal finance as well. So we were on the training and the facilitator came into the room, just as normal. You just, excited and, curious, just want to learn. And then he came into the room and he asked us to bring out a pen and a paper. And then he asked us to write down how many years we had worked. Then we wrote it down. Then I'd worked only like 1.5 years. I wrote it down. And then he asked us to write how much salary we had earned in each of those, months, that we had worked. We wrote it down and he asked us to multiply that amount by the number of months we had worked. We did. And then he asked us to write down how much we have in terms of savings, in terms of investments, that we can point to as financial assets, basically. And then I started to see men, with tears. It was a truly humbling and sobering experience because, I just worked 1.5 years. And even for me, I was like, so I've earned this much. So people were in that room that had worked 5 years. Some people had worked 6 years, thereabouts, some 3 years, that range. And they could not believe it. So this is how much has come into my hand. And this is, what I have retained. So basically, that's what net worth is all about. That's what we did. How much is it that you have today? You understand in terms of assets, and then what are your liabilities? That is your net worth. What we did was, just looking at our realities in the past. What is our past reality in terms of income that has come to us and what did we retain? But for now, talking about your net worth is your assets. What do you own today? And then what are your liabilities? Your assets are simply, whatever you own, that has a monetary value that you can put money to. Your houses, jewelries, your furniture, cars, anything that you can put monetary value to is an asset. You can have cash, investment accounts, retirement accounts, properties, real estate, everything that has a monetary value is an asset. So you put all that together, total the sum of that, that is your asset. And then you now talk about your liabilities. Your liabilities are simply any debt that is owed by you to a third party, debts owed in the bank. You have credit card, you have mortgages, whatever the balances, today that you owe anybody is your liability. Subtract those liabilities from your assets. That is your net worth, right? So it's very important for you to understand your net worth, because it will determine where you're starting from. You cannot save or invest what is not yours. You rather save what you have, and that is your net worth. What is it that you have to save? What is it that you have to invest? When you talk about investment, that's your net worth. Now, if you do this exercise and you have a positive net worth, congratulations. If you do and you have a negative net worth, no problem. There's still room for improvement. What it means is that you need to start to think about paying down your debts and then, moving over to a positive net worth so that you can start to invest, start to save, do what you have to do. But it's very important that you understand the starting position, and your net worth can change. It can change between this month and next month. So you need to do it constantly. Something that as you're doing, I understand that there's someone else that is taking budgets in and all of that. So I'm sure that person will touch on, how you need to budget, understand the different categories and track your expenses, track your income. Now, as part of that, you also need to track your net worth. What am I actually worth? Am I just working, accumulating, and then spending all of this and, not retaining it? And, that's a food for thought. And that's, training for me was when there was an eye opener for me for my personal finance, because at that point I told myself that at least I have to save 25% of my income. And by the grace of God, I've been consistent with it. That's over 12 years ago. I decided at that moment that I have to save over at least 25% of my income every month. And so you just need to understand your net worth. That's basically where we start from when we talk about personal finance. And then we go over to financial goals. I spoke about this before, that you need to understand your financial goals. At the short term, at the mid-term, at the long term, you need to determine. You're not just going to invest money that you don't need for 20 years in short-term investment. It doesn't make sense, because you're not going to get enough returns. You're just, working for the bank majorly. So, and you're not going to put money that you need in a year time in a long-term 10-year investment, because by the time you withdraw it, what it means is that you lose part of your principal, because you're not following the contractual obligation. So it's very important that you do your matching, short-term for short-term goals for short-term investment, mid-term goals for mid-term investments, long-term goals for long-term investments. That's basically what that slide is all about. All right, let's quickly go to investment objectives. So your investment objectives, just like I talked about, your goals could be short-term, mid-term, and long-term. You could also have objectives that you need to meet. It could be for safety of your principal. You understand? For someone that is retiring, is very careful to ensure that his principal is not depleted, because he wants to make sure that he's able to, have this principal for the time being. Since it's not working, he's not expecting anything to come in. He wants to ensure that he does not lose some or all of those principal. But for someone that's just started, work, can afford to play with money, can afford to trade, and safety of principal is not a priority. And so this also determines the risk tolerance, of different people. You find out that young people are more, in terms of risk tolerance is higher, because they can afford to lose their principal, because they're assured of, more money is coming in and all that. They have a higher, risk tolerance. And then you talk about steady income, interest, dividends. Some people are more concerned about having steady income. Probably they have some cash flow needs, a specific period in time, and then they're looking to invest, make some investments that will bring in cash inflows to take care of those cash outflows. So they're looking at steady income in terms of interest or dividends, to come in to take care of that. And then another investment objective is growth of capital. That's capital appreciation. You want to put in some money, and then you're looking at having returns of 10% returns, but not in the immediate future, maybe over a period of 5 years, over a period of 6 years. You're expecting that, maybe stocks, you're expecting that your stocks should have appreciated 3 times and all of that. So those are investment objectives that individuals may have, and you need to determine what are your objectives when you're investing. You're not just investing for investing's sake. Why are you investing, and what are you looking to get? Before you even go and talk to your financial advisor or banker, have an understanding of what you're looking for. And so when they are recommending, because some people are just salespeople, they will just recommend what they have. They're not looking at they're not looking at the suitability of that investment to your specific situation. So that's why you also need to have a knowledge of, it, so that when you're talking to them, you already know what you want or what you don't. And then we'll quickly talk about the common investment classes. We have money market securities, fixed income securities, equities, and alternative investments. For money market securities, I'm sure that most of us are familiar with this. There are securities that have maturity. When we mean maturity, it means that the term of the investment, right, is less than a year, and it can easily be converted to cash, like your fixed deposits, your treasury bills, your BAs, bankers' acceptances, and your commercial papers. Those are all, money market securities, short-term investments. They have maturity of less than a year, and you can convert them to cash. At any point in time, you can always withdraw your fixed deposit. You can always withdraw it and say, I need my money. So it could be for 3 months, 6 months, or 1 year or thereabout. And the investment objective for money markets, why would I want to put money in money market security? Basically for safety of principal and for income. So if I'm looking to using that fund, let's say in the next 1 year, I'll probably put it in a money market investment. But if I'm looking to use it in 3 years, why would I put it in? If I don't need that fund for 3 years, I will not put it in a money market security. Do you understand? So for safety of principal and for income, within that period of time is why you would go for a money market security. And then fixed income. What are fixed income securities? Basically, you think about your bonds. They are essentially government debts or corporation debts. What do I mean by that? Government is borrowing, or the corporations, the companies are borrowing, from the public, and they do this by issuing bonds, and those bonds are saying, borrow me this amount of money, and I'm going to be paying you, this fixed interest over a period of time. And you're also assured of your principal, right? You're assured of whatever you've put in at the end of the day, at the term, of the investment. So that is what essentially fixed income securities are. And they can be short-term, medium-term, or long-term bonds, issued by governments, issued by companies. And one reason why you want to invest in fixed income, or reasons why you want to invest in fixed income securities, is for safety of your principal. So you are assured of safety of principal within, that term. So if it's short-term, maybe like 2-3 years, you're going to invest in a 3-year bond. Of course, you don't need the fund in 1 year. You need the fund in 3 years. If you're going to invest in a 5-year bond, you don't need the fund until after the end of the 5 years. You understand? So you need to understand, this timing. And that's why you need to determine your short-term goals, your mid-term goals, and your long-term goals, and then allocate your investments based on those investment, goals that you have. So you're looking at buying a car in 3 years. Of course, you're not going to be putting money in money market security. Essentially, you want to put the funds in a bond and then make sure that you have enough, income. And you're also looking at maybe having regular income. a stable regular income and still have your funds in there. If you have a stable regular income from the payments of coupons, you go for a coupon paying bond, because you could have zero coupon bonds. Most of the bonds, most of the common bonds we have are coupon paying bonds, and they pay coupon in 6 months. Semi-annual coupons are usually paid to you. So just trying to explain the reason for certain investments, and then why you would want to put your funds in those investments. And then we go to equities. Equities are essentially shares, just like, shares of a corporation. We buy into the net assets, basically, of a company. When you buy shares, it means that you have access to the profits of the corporation. Now, the downside is if the corporation does not make profits, you do not get anything. Right. And if the corporation, goes down, if anything happens and it liquidates, you can also lose the value of your shares, at that point. And if anything happens to the price of the shares and it drops, you're also affected. So as much as, is also, you have possibility of high returns, you also have possibility of the risk of you losing some or all of your principal. And the investment objective, why you would want to buy shares, are basically for income and capital appreciation. And these are, for long-term investments. You're not looking to buy shares in order to make, except you're trading. For those that are trading, that's a different area. That will be alternative investment. If you're looking to buy shares, you're not looking at a short-term investment. You're probably looking at long-term, and you have probably, done some research, or maybe you have investors that have done some research and they know about the company, and you're sure that, you can have some level of capital appreciation. And in terms of income, if you need income, you're sure that profits are going to be rolling in and you have dividends from the company. So that is it in a nutshell. And then you have alternative investments. Those are specialized investments. You have commercial real estate. Some people invest in that. And you have real estate investment trust, where you put in monies together and, buy commercial real estate and then own holdings of that, whatever returns is coming from the real estate. And you have derivatives. Some people, do trading in contracts and, sell puts, calls, and all of that. Those are alternative and specialized investments. It's only when you have knowledge of those investments that you're advised to typically go into them. But the basic ones are the money market securities, fixed income securities, and the equities. All right, so I'll just touch on, before we close, I'll just quickly touch on mutual funds, because mutual funds, seems to be like the most common type of investment that someone that is not even a financial expert, you can always put your funds in it and make some returns. And so what are mutual funds? I'm sure we keep hearing it, even in Nigeria, mutual funds, or you can put your money in mutual funds. What are mutual funds? Essentially, mutual funds are just investments that collectively hold a variety of securities. I've spoken to you about investment types: equities, bonds, fixed income, and money market securities. So mutual funds will hold, different varieties of these, because there are different types of equities, different kinds of bonds, and different kinds of money market securities. So mutual funds will hold a variety of the characteristics of all these types of securities in different proportions, depending on, what your needs are. And a typical mutual fund can hold dozens or hundreds of different securities. And there are two types: there's closed-end and there's open-end. Open-ended mutual fund is more common. The closed-end has a fixed number of holdings, which means that if they say they're selling 100 to 100 units, that's all. Once the 100 units is over, they're not selling to anyone again. The open-ended mutual fund is the most common, where you can always come, just put in money, just like your fixed deposit, and then buy, some units of the mutual fund. And you have different types of mutual funds. You can have money market mutual fund, which contains a higher proportion of money market. It holds other securities, but it has a higher proportion of money market, depending on your, just like I've said, it all depends on your needs. The suitability, your personal situation will determine, which kind of bond which kind of mutual funds you're most likely to subscribe into. And I'll just quickly go to this so that we see a summary. So for money market funds, for an investment objective of safety and income, you likely go for a money market funds, and that your risk tolerance is low. You don't want anything to touch your principal, so you just go for money market mutual fund. And that money market mutual fund invests mainly in money market securities. So it takes different kinds of money market securities, GICs, treasury bills, CPs, and invest in it. Fixed income funds invest strictly in bonds. And the reason why you want to do that is for steady income, payment of coupons, you get some interest and some capital gains from a fixed income fund. And then you have the balanced fund that combines equities and bonds. You understand, different kinds of equities, can take equities from different countries, different jurisdiction, put everything together. Bonds can take different kinds of bonds, together and put everything together under that fund. And these funds are usually managed by fund managers. They will give you the specific characteristics of the fund. A lot of times we don't look at it. People just, I just want mutual fund and just subscribe to it. So it's very important that you understand the fund. What is the makeup of that fund? Is it just money market? Is it just bonds? You know that if the market is falling, if there's inflation risk, for instance, you understand, your equities will be affected. So why would you go for equities, a fund that has, more of equities? Do you understand? So you want to diversify your risk and, just look at different, bonds which you can put in your funds and the characteristics of this. And if you're looking to long-term growth, of course, you're not going to put your money in money market funds, because equity funds would, you're looking to grow your funds on, and your goals are on a long-term basis. You have long-term, goals. You will likely put your funds in equity. So this just summarizes, just tells you what to do, in terms of your investment goals, which kind of investments to go for. What are the benefits of mutual funds? Mutual funds are great. Basically, they just help you to, I would say, first of all, for me, is the diversification of risk that mutual funds, provide. Because right now, what it means is that you are able to take from different characteristics of funds, instead of you having to invest some funds in treasury bills, invest some fund in commercial papers, invest in GIC in Canada, everything is combined, together for you and put together in one place. So you're not putting your eggs in one basket. You're not just investing in treasury bills. And it reduces the risk of owning one security by you now hold different kinds of securities from a different number of issuers. Different people are issuing the companies, governments, and all of that. Everything is put together. So you are able to diversify your risk. Another thing for me is liquidity management. Mutual funds, just like your money market securities in future, the fact that you can easily sell it and convert it to cash very quickly and easily. And then you have low cost. It's low cost. You almost, do not run any expenses. If you are going to own a stock, for instance, if you're going to buy a stock, you can imagine the professional management of checking, whether the stocks are going to perform. You have to pay for the administration of the fund and all of that. You don't need to do that with mutual funds. If you are going to have equity mutual funds, everything, professional management and, administration of the fund is affordable because the cost is shared among numerous investors. That's why it's a mutual fund. So everybody's putting their money together. So the cost of administration is shared. And that's what you call the management fees, which you don't even know that is being taken at all. Everything is, inculcated in your returns and all of that. They'll just give you the statements at the end of the day, and it's very negligible. But if you have to do that with a stockbroker yourself and determine the different kinds of securities you want to own, it's a lot of money, I tell you. And so it's lower cost. And then talking about the convenience, the fact that you can do that over the phone, you can call your account officer and subscribe to mutual funds like how you want it. And then you have professional management. You have professionals, telling you, oh, this is the kind of fund you should invest in based on your particular situation. They can advise you, at no cost and sell you the best mutual fund. So, so those are the basic types of. So I cannot go through all the kinds of investments, but I hope have been able to give you like some lead to select if you want to go, to subscribing to any investment. At least you have some lead to know, okay, what am I to look out for? What am I to determine? My investment goals, what are my investment objectives? All that needs, to be at the top of your mind before you go ahead to choose any investment. Before I round up quickly, I'd like to, take this call to action. I'm very passionate about budgeting, and I told I told Bridget, but she said someone else is taking it. I'm very passionate about, people being able to track their expenses, their income, because it's very important. To reach financial freedom, you have to defy social norms. When I mean social norms, you have to forget about is it living with the Joneses, living like the Joneses. You need to forget it all about that and focus on what do I have today? What is my net worth? Start with that. And then what is my expected income? How is this income? How does this income, tally with my expenses? A lot of people do not even know how much income comes to them monthly. Of course, most entrepreneurs, because they get monies from different, some people, because they have salaries, they actually have an idea of what comes to them. Even those people that know what comes to them, they do not know what exactly comes out every month. Now, this is not very good. You need to be able to track your expenses and your income on a monthly basis. How much came in? How much did I spend? How am I faring every month? You should be able to do this at the end of every month. And the first step towards financial freedom is to calculate how much you actually spend annually. I don't know whether any one of us has done that exercise. Go back to your accounts last year. For us, it's easier because most of what you spend comes from your account. So it's very easy for you to do a total analysis of how much you spent. Go back to how much you spent last year and how much actually you made last year. And, that will begin to open your eyes. How much have I been able to retain from people will say there's no money. I'm not earning enough. Yes, you're not earning enough, but that's that you are earning. How much are you retaining from that amount that you're actually earning? Very important. And you have to. So the two ways to financial freedom is either you're making more money to cover your expenses, or you're reducing your expenses so that you're able to, save more. You're able to invest more. So you need to also work on lowering your expenses. One exercise I would advise is to work out how much of your life you're actually trading for that expensive item you are buying. Okay, so let's look at how much hours you need to work and how much income you are earning for those number of hours. Then that bag, that $500 bag, how much of your life do you need to work to get that bag? By the time you have that consciousness, sometimes you carry the bag and you drop it and walk away because you know that I'm not up to this yet. So you need to consciously, have that thought at the back of your mind, lower your expenses if you can, and then aim to save a minimum. That's a rule of thumb of 25% of your income by reducing your big three. Now, what do I mean by big three? Big threes are your housing, food, and transport. If you go back to your statement, you'll discover that those three things, form a bulk of what you actually spend on. It may not be all this, small things like that you just, all the 10 naira, 20 naira, that's not the big deal. The big deal is food, housing, and transport. And those are the major things that take up your income. You may want to look at it and try to see if you can reduce it in any way you can. Those are the three. If you are looking to reduce anything, the expenses, those are the three you need to first look at, of course, before you start looking at those things that you buy, on impulse that is not necessary. And you need to seek professional help, have a financial advisor, seek the help of your banker or someone that is trusted, in order to be able to plan your finances. Proactively also look for ways to optimize so like I said, is either you're reducing your expenses or you're earning more. So there's no two ways about it. So after you've determined what your net worth is positive, or you've determined your income every month and your expenses, and you are still spending within your expenses, then you need to look for ways to proactively, if your income is not up to what you desire, you know, that baby girl life you want to live, you want to go to Jamaica, you want to go to Turkey, you know, and you need to be able to meet, you know, those demands, then you need to proactively look for ways to optimize your check, your 9 to 5 paycheck. Very important that, so that you'll be able to meet those needs. Look for other ways of making income, basically. And lastly, you need to research and choose your investment options properly. Do not invest in something because your friend said they made money, you know, last year. Last year is not this year. The economic, you know, what do you call it? Environment is changing daily. A lot of things are happening now. There's some things you should not even put your funds into right now. So you need to seek professional help first and make your research properly before you choose any investment option. Wow, it's 301. Thank you so much I hope I've not bored you.
Wow. Wow.
Sincerely. Yeah, thank you so much for having me.
No, thank you so much, Oludolapo. Like, this has been so eye-opening for me, you know. I don't know about anybody else here, but I've just been taking notes, a lot of things you've said. I know we'll have a few questions, but before we just even go into the questions, I wanted to kind of like just share my own those, you know, the things I got from you that really stood out for me. So you talked about how personal finance is really to ensure that you can meet your future needs and avoid, you know, financial risks. Talking about quitting the herd mentality approach in your personal finance and having a savings goal. So what are you saving for? How long are you saving for? What, as in towards what, you know, what's the goal? Because if you don't have a goal, basically, you're not going to be committed. And it's not just about saving, but it's about investing to be able to grow the savings that you have done, basically. And having a solid retirement plan, it starts from the first day. The first day you start to earn money, either as, you know, an employee or as a businesswoman. You now start to think about, what about the day I retire? What's going to happen to me? You talked about having an earnings buffer. That's 6 months salary. When you said that, I was like, hey, okay, 6 months salary at any point in time. If you don't have this, then you should start looking into it, basically is what she's saying. And you talked about matching, you know, your goals, your investments. So you're saying you have a short-term goal, you've got to match it to a short-term investment. The money that you don't need in the immediate, there's no point putting it in a one-year fund, like, you know, that doesn't make sense. Like the money market funds you spoke about, it's better to put it in something more long-term, because the longer the period, the higher, you know, the rates that you can get, the higher what you get back. You talked about arming yourself with knowledge before speaking to your banker or your financial advisor, because some people just want to make a sale. So you need to be able to tell if what this person is saying to me actually makes sense, or maybe I should be speaking to someone else, right? You talked about how mutual funds gives us access to like a variety of securities in one bucket. So it allows us to diversify our risk, and it's also very convenient. So you don't have to start thinking about, you know, different types of investments. It's just provided to you in one bucket. And you said, regardless of your earning power, you need to start to think about how much are you retaining. Now, one of two things has to give. You either have to lower your expense or increase your income. And when you want to spend on those things, you ask yourself, how much of your life are you giving for this, you know, this Gucci bag? Am I going to give a whole day, 24 hours of my working life just to get one Gucci bag? Doesn't make sense, right? And then you talked about watching your big tree, which is a housing, the food, and transport. And then stop impulse buying. Basically, you need to have a budget and, you know, plan for things. And most of all, research, and choose your investment options wisely. Like, thank you so much. This has been so enlightening, so enriching. Like, the knowledge was just oozing out of you, you know. And I'm so sure that we have a lot of questions. I saw there was a comment in the chat where people want to really understand, because you kind of pitch this at a certain level. So when you're talking about GICs, you're saying equities, you're saying securities. Girl, what are you saying? I don't get it. So you might
Yeah.
want to break down, you know, these things
Yeah.
for us a bit more. I know someone was asking about GICs in particular. So if you just want
Yeah.
to touch on that.
Yeah, GICs are just, equivalent of your fixed deposits in Nigeria. It's guaranteed income certificates. That's what it's called in Canada. It's basically the same thing. With the bank, offers you, that opportunity to invest in their money market securities, more like just taking money from you and investing and paying interest on it. That's it.
Okay, thank you so much. Sisters, please, if you have questions, feel free to raise up your hand and I'll call you to unmute, or you might just drop, your questions in the comments box and I'll be happy to quickly read it out. I know it's a lot to take in. When you talked about the exercise about calculating everything you've earned and looking at what you have left, at that point, the table started to shake. but it's all good. I mean, these are conversations that we need to have. And, regardless of whatever has happened to the past, there's still so much of the future in front of us, right? And we need to start to make, the right decisions with respect to our finances. So any questions? Okay, I see a hand up very quickly. I want to call on Oludolapo. Please go ahead. The floor is yours.
All right. Thank you so much for the presentation. Really insightful.
You're welcome.
Well, your presentation got me thinking, just personally because of me.
Yeah.
Honestly. And I just want to ask because it affects me so much. Maybe I would say in a negative way. I would just like to ask, for someone like me, where do I start from?
Okay, what do you currently do? When did you start working? What's your situation like? That will determine where you want to start from.
The situation is with the savings, actually. I've not been able to monitor my savings, and so I don't think I'm in a good place. And I've started working since 2013.
Okay.
So that's in almost 10 years now.
Yeah, so I would say do not beat yourself too much. I know it's so much to take in, and that was the same reaction I had, at that session that I spoke about. So do not beat yourself too much. You can always start from somewhere. And what I would advise, first of all, is determine how much, you make. And that's way you can do that by starting with your monthly income, what actually comes to you every month. Have a budget. Before you can even have a budget, you need to understand what comes to you every month. So like, for instance, you earn maybe like a 500,000 every month, and then you need to determine how much is your monthly expenses. How much of that 500,000 actually comes out every month. In order to determine that, you need to allow 1 month or 2 months to pass. So you need to track your income, track your expenses. I think I have a budget template I can always share. I can send it to Bridget. That can also help you. That budget template has helped me a lot. I've been using it for over 6 years now, and it's very good. So essentially what it enables you to do is to be able to fix in your income and your expenses on a monthly basis. So from that, you're able to deduct those expenses from the income and know what is left at the end of the day. Now, if you're not spending within your income, you already know that you are like overspending already. And it helps you to be able to track the categories where you are actually going above. Do you understand? So if it is food, if it is transport, if it is, on luxury, other things, different snacks, whatever it is, you're able to write that down. That's templates as, those different categories. You're able to assign your expenses to those categories, your income to those categories, and then determine where you are actually spending more than you should spend. If you do that exercise twice, like 2 months, what it does to you is you can go back to those categories and say, okay, I am not going to spend, so amount on this again. And that's where you've been able to cut, some parts of your expenses, and you monitor. You do that consistently over a period of, let's say, 6 months. It becomes a part of you. So when you have to send, when you have to go online to buy that product, or when you have to walk into the shop to do that, you said, no, I have an alternative. I need to do this. I'm not going to, buy this item. So it's just for you to track, basically. By the time you track, you will know where you are spending, where you're actually overspending and what you're actually spending on that you're not supposed to spend on. So once you're able to do that tracking, it's now left to you to make the decision, on what you want to cut on or how you want to make additional income, as I've said, maybe to cover your needs. And if you cannot make additional income, then you ultimately have to cut your expenses. That's just it. You don't have a choice.
Thank you. Thank you.
Thank you.
Does that help at all?
Yes. Thank you.
You're welcome.
So there's a question in the comment section, and I just want to know if Dolapo has answered it, while speaking just now. So the person is asking, please, can you make a practical example of what someone who earns 200K a month and has absolutely no investments or savings can do? I think you kind of touched on that. So to the sister, that was Bumi. Do you still need her to speak a little bit more to it, or are you okay with what she said, please?
Oh, yes, she can speak. When you are actually in terms of figures now, right?
Yeah.
Like actually earns, there are people that earn 100K and feel like
Sure.
there's no space for them to save. So what I'm asking, a practical way that they can actually, even though it looks like it's not so much, right? Even though it looks like it's not so much, they can still at least do something for themselves. And when we talk about, investments, you mentioned so many avenues. Some of us cannot carry our 100,000 and go and sit down with a bank account officer. They will not even give you, you are not people they are looking for. So some of us are just, lost in the wealth. Some of us were earning 100,000 and we want to save in dollars. It sounds important, but we know that there are ways.
Of course.
So that's what I'm trying to say. Like, is there a way you can make it, very, practical, so that people can actually say, okay, you know what, I'm actually going to set aside this amount of money, and these are the kind of places that I can put this money and just close my eyes. I know that, okay, something is going to happen.
Yeah. So, like I mentioned before, thank you so much, Bumi, for that. Like I mentioned before, the first thing that you have to think about when you want to save is, what is your goal? What are you looking to achieve? Are you saving for saving's sake, or you just want to put money in fixed deposit for fixed deposit sake? What exactly are you looking to achieve? What's the monetary value? What time do you want to achieve this goal? If it is you want to buy a car, maybe in 3 years, you want to buy a car of maybe like 2 million naira in 3 years. Is it feasible? How much do you have to put together in 2 years in order to be able to buy the car? You want to build a house. How much do you need, and how long would you need to save to buy the house? So all of that, why it looks always so big is because we don't even have an estimate of how much we want to save. We don't have an estimate of exactly what we are looking at, and we have not allocated time to it. And so if you're looking to have 2 million naira, for instance, in 2 years, that's 2 million divided by 24 months. It means that you have to save, let me make it 2.4 million. 2.4 million divided by 24, it means that you have to save at least 100,000, right? Am I correct? 100,000 every month. Do you understand? Every month you have to put together 100,000. Is it feasible from your 100,000 salary? No is the answer. So what it means is that you have to earn more in order to be able to meet this goal, or increase the number of years to meet the goal. There's no other way. It is mathematics. So if this is what I'm earning now, is either I need to look for ways of earning more in order to meet this goal, or maybe I need to increase the number of years to make this goal. So let's go back to savings. If you're looking to save, let's say a 200,000, you're earning 100,000 right now. You want to save 200,000 in 1 year time or 2 years time in order to be able to meet, university education of your children or secondary school education or whatever you need to meet. You know that, of course, you need to start putting together about 10,000 naira every month. right, from your 100,000. So it means you need to, come back to reality that whatever I have to spend, right, cannot be more than 90,000 naira from that salary. And as a rule of thumb, to get to a level where you're financially secure, as a rule of thumb, it is advisable to save at least 25%. So if we are saving 25%, for instance, of 100,000, it means that what you're earning, what you are going to be spending every month, whatever you're going to be spending must not be more than 75,000. So you need to have this, it's just psychology. You need to have this at the back of your mind and immediately begin to adjust your lifestyle to 75,000 naira. And it means that some expenses that you would ordinarily take, you need to start, telling yourself, this is not for me right now because I have a goal, I need to meet. And luckily, if you're able to increase your income, all well and good, you're able to adjust that again and say, okay, I can, take care, I can take a little bit of expenses in, or I can do more savings. The problem is that we have not even quantified exactly how much we need or how long we need to save. So we just decide that, okay, I just want to put money in fixed deposit, or I just want to put money in mutual funds. No, you need to determine what your savings, what are your goals, basically, what are your goals for now? Of course, nobody says do not dream big. If you dream big, then you need to find ways of meeting, those dreams. Your brain will start working when you know that you need 2.4 million in 1 year and you are earning 100,000 naira. That is not feasible. That means you need to look for a way of making extra income. But if you do not have any goal, you are just looking to, I just need to put money. How much? You don't know. When? You don't know. You're not saving. And that's what a lot of people do.
Thank you so much, Dolapo. I just wanted to add from my own personal experience. For me, I think for those who struggle with saving, one thing I would say is just start small, right? And save before you spend. So it's an attitude thing. It's something that your brain just has to align with it. You have to save before you spend. So you don't get the money and start to apportion it. Oh, I need to pay my bills. I need to do this, do that. When you finish doing all of that, there will be nothing left. So if you want to spend first and save the remaining, you're never going to save anything. You have to take out the savings first. Then look at what you have left and start to apportion it. If you used to spend 50K on feeding before and you see you have only 75K for everything, obviously you're not going to be able to spend 50K this month. So that's how to go about it. The second thing is that if you struggle with saving, maybe you want to, set up some kind of instant debit to your account so that you're not the one going to take the money and put it there. You want something that takes the money either from source, if maybe your organization offers such, options for you, or you want to set up something that debits your account monthly to a particular amount and saves it somewhere else. Now, for that place you are saving, that is that other account where you're saving, you don't want to have ATMs, you don't want to have, checks or anything on it. You don't want to have access. You want to make it difficult, like you need to go and line up in the branch, line up before you can get your money. When you think about all of the stress that you might need to go through, you most likely will, you'll be able to kind of like hold yourself that, no, that money, I'm trying to save it, for that particular purpose. So those are some of the ways I feel, people that struggle with savings, you can put in these little things in place and just maybe it might help. And one thing I found helpful was when I first started working, I was working in a branch. So we had this, this Isusu type of thing that they would just debit everybody's account. And they asked me to join. And in my mind, I was like, do I really want to do this? But I said, okay, just take 5K. They took 5K and by Christmas they gave me 60K. I was like, wow, this was like my first year. I was like, oh my God. So that was what just helped me start saving. I knew immediately, like, I would have had 60K to, rock my Christmas if I hadn't done that 5K. So by the next year, I increased the amount, and that was how I started to, get into the whole savings game. So I hope this has been able to help for anyone who needs this. Then I see another question in the chat. I'm just trying to find it. It was something around, there's so many comments now. It was something around how
I think I want to answer one from Bumi. She said, some of us, it's not shopping or it's family conundrum. My sister, Whatever is not available, right, is not available. It's because it's available. That's why the family can have it. Just like Bridges has said, if the money is somewhere where it's not accessible, you will have to make, means from what you have available. And that which is not available is your savings, is your investment. You're not going to touch it. So you need to make a way, find a way of ensuring that your savings is your savings, comes out of whatever income you have from the beginning, just like your tithes, for Christians, comes out of your income and is not accessible to you. Just like I've said, if you're earning 100,000 and your saving is 25,000, just know that you are earning 75,000. That's it. So in your mind, that 75,000 is what is available for whatever family issues or whatever, whoever wants to borrow money, whoever wants to, have something. And then when you have a budget for family issues. Have a budget for charity. Very important. If somebody is always asking you, oh, borrow me 5K there, borrow me 10K there, have a budget every month that, okay, this is the amount I want to allocate to whoever is saying, urgent 2K, urgent 3K. And once that is exhausted, you say, sister, please, can you wait until next month? And that helps you to manage yourself, because there's this thing about timing, timing of your cash flows, which is very important. The more you don't even know how much you're giving for that urgent 2K when you're just giving it. Anytime the demands come, you're saying, oh, I need to answer this person, and then you quickly give it out. They tell you, oh, it's urgent. If I don't have it now, I will die. Story. You will know which one is urgent and which one is not. So you need to manage that. When you have a budget for charity and you've exhausted it, for instance, April, please let the person wait till May. There's May budget. May budgets can take care of the person, and you don't have to meet everything the person has said. You meet it within your budget, within your means. Live within your means. You are not Father Christmas. You are not more. It is what you have that you can give. You can't give more than what you have. So please, there is no excuse. We just need to live within our earnings, basically. It's either we live within our earnings or try to increase, find ways of increasing those earnings. But once you have your earnings, live within your earnings and make sure that you still have something, however small, even if it's 2,000 naira every month, save something.
Thank you so much. And I see another question. What is the acceptable miscellaneous percentage of your income when budgeting? So after you've done food, clothing, shelter, whatever else, that little money that you can just, sometimes enter, sweet sensation, give yourself a treat. What would you recommend to be that percentage?
For me, I would say 10. Nothing more than 10% of your income should be for that. And see, if you have some needs that you need to, if you have needs like, let me say, buying clothes, buying shoes, or buying bags, you can actually allocate your budget to meet those needs at specific periods in time. So you can say, okay, maybe by July, I need to have this in place. And then you put it in July's budget. But if you don't, what happens is that in April, you buy a bag. You forgot that you bought a bag in April. You buy it again in January. If you see another fine bag in September, you buy it again. But by the time you allocate and say, oh, I'm going to refurbish my wardrobe in July or in August, or maybe when there is a sales, for us here, there usually sales during summer. Okay, there's going to be summer sales. Okay, by September or by August, this is what I'm going to do. Maybe the children's wardrobe, their clothes are, worn out and all of that. You set specific budget for that time. And when you are doing that, you know that it's not the time that you are meeting school fees that you are going to be doing clothes. It's not the same time. So all of that, you've put it in black and white. And the budget template I have is such that it's 12 months. You're able to look at your budget from January to December and decide, okay, this is when I want this allocated. I want to write, like maybe you want to write exams, or you want to register for an exam, and the registration is in August. And that same August is when you want to buy a Gucci bag. It doesn't make sense. So you need to allocate your expenses, by time, allocate it by the income you have, and have it in black and white.
Okay, so there's another comment here. Thank you so much. Some people are asking for your contacts. They want to contact you directly. So I don't know. How can we contact you if we want to? And are you open to it?
No issues. You can share my WhatsApp number, Bridget, and my email address.
Please, for all of you that used to steal bestie, let me just be shouting it here now. I will beat somebody. This is my own bestie. So as I'm sharing the contact, please. Only financial conversations. Only financial conversations.
Get ready to beat your sister. Get ready to beat Brenda.
Get ready to beat.
It's like I'm not even going to share the number again.
I didn't even understand why we're even just embarrassing ourselves. We've been quiet all along. It's at the end we want to embarrass ourselves and show ourselves to Dr. Oludolapo. Wow.
No, any other questions? Like, this has been so enlightening.
Yeah.
I know we've kept her a little over the time we had allocated, but I mean, too much value. We can just take one or two more questions if there's any. In the absence of any, we can just call it a day. So any questions? Hope I've not missed anyone in the chat though. Let me quickly go through. I don't think so. I think we've taken all the
No, you didn't. You said everything out. We're good. Thank you.
Oh, okay. That's good. Thank you so much, Dr. Oludolapo. And I'm just going to hand this over to our dean in the house. So Abby is the dean of the TOCI Education Unit. I'll just quickly hand it over to her so that she can give, our vote of thanks. We are so grateful for making our time to be here. So Abby, over to you, please.
Thank you so much, Dr. Oludolapo, for sharing your time and your wealth of mental resources with us. I learned so much. And Ifwe or Bridget, really, I had to learn from her that your name is Bridget and you're supposed to be my assistant. But anyway,
I've said it many times here now.
Thank you so much for the recap that you did. Thank you for the recap. Thank you so much. Everybody learns. We will share this recording for anyone who missed it. And thank you for allowing us to share your contacts, email addresses. But we pray that they don't bombard you too much. So we'll start with email and then maybe move on to WhatsApp numbers later. Thank you so much, everyone, for joining. God bless you. Thank you.
Man, thank you so much, everyone.
Thank you. Bye. Sisters, please feel free to unmute and, just thank Dr. Oludolapo. And please,
thank you, Dr. Oludolapo.
Another time.
Thank you.
Thank you so much.
You're welcome.
We are grateful. Thank you so much.
Thank you so much for joining.
Thank God. Thank God. Thank God. Love you, everyone. Love you all.
Thank you.
You're welcome.
Thank you.
Bye.
Good night.
Good night.
Bye.
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 Bye, everyone.